Perfect. So good evening, everyone. Thanks a lot. I think is it 1, 2, 3, 4, 5 day 6, right? Officially. Uh, so what we will do today is, as I mentioned, we'll go through options on the side of currency and interest rate derivatives. What I will do is I'll quickly glance through the chapter just in front of you. It's the same thing, right? Whatever we have discussed, call, put, ITM, OTM, ATM, the payoffs, long, short, whatever the Greeks that are available, American option, European option, so these are all the concepts that we studied over the last 2 days. I think this is where most of the questions do come from. And then again, it's the same parallel thing that you will see in currency. It's the same parallel thing that you will see in the interest rate derivatives as well. Okay. That's where, we have divided this entire, study pattern into. Kindly mute yourself, please. Yeah. So that is why what we have done is, we have actually, sort of build this based on the theme so that it is easy. You study one topic and then, you map the topic onto the next theme of the exam there, right? And rather than studying from page 1 to page 10. Okay. Any questions on the options? And I'll quickly share the screen. Any questions on options? Whatever we've discussed. Either you are actually super clear, no. Okay. Yeah, that's what we're doing, Kamal. So that's what I mentioned, see, once you study this one particular topic, right, it's the same across, all the chapters there. That's what I was trying to, tell you guys. What we will do is, so this is currency derivatives, introduction to options. It's the same thing, ditto, right? It's just the replica of what you actually see in the equity statement with quotient. Same thing, it's same, you won't even say anything different there. But what we will do is, we will just quickly go through the higher level per se, so that you are also comfortable and you feel that we have covered this topic. Okay. Okay. Quickly, let me get this to the screen. Okay. So this is currency derivatives, right? Again, I'm not going to do any PPT sort of stuff. This is exactly what we have done, in the equity derivatives in detail for almost 2 days. So what is it talking about? Basics of options. Very quickly covering that. And what is an option? You have the right, no obligation. That's what it is all about. And then we discussed about call option, put option. Call option is the right to sell, put, right, sorry, call is buy and put is, right to sell. We discussed about strike price, spot price multiple times. We discussed about, expiration date, we discussed what is an option buyer and seller there, option premium, how the premium is arrived, etc. and all. We discussed again difference between futures and options. What are that? Futures are standardized contracts, and they need to be honored. Options are only the right, you don't have any obligation to honor the contract. That's the most important difference, right? And again, we discussed the style of options. Same thing we mentioned multiple times, right? American options and the European options. Again, just to repeat, what is European option? The options expire only on a specific expiry date. American options can expire on any day. Okay. Money settlement option we studied in detail. ITM, sorry, ATM, ITM, and OTM. The spot price, strike price. We went through the housing example in detail. Always remember, right, whenever you have the doubt, just go back to our example and just put it on the paper, right? Even in the exam, 1 crore is always going to be your strike price. Now, what is the spot price there, and then based on that, you answer the question. Okay. So that will, in case if you have any doubts, on how to solve that, right? Again, we discussed in the money, at the money, multiple times, right? Yesterday and day before, strike price is less than spot price. At the money, strike is equal to spot, the same thing, That's what like we were like, again, I keep repeating, like once you study one chapter and the theme there, it's the same across, the other, books as well. Now we studied equity derivatives. Now this is currency derivatives chapter. You can see, right? Nothing has changed. Okay. The same thing, right? We studied about intrinsic value. What is that? Spot minus strike price. Time value, we mentioned about, what is the associated value. We took the example of the lottery, ticket there. And then we also mentioned about the, time decay concept there as well, right? We learned that. And then option pricing fundamentals, again, it's the same thing. Spot price, strike price, volatility, we discussed. Time to expiration. We discussed about this option Greeks. In case if you want to do any math, they generally don't ask it, but in case if you want to practice any math, you can come here and do that. Delta, what did we say? What is the change in the option price for me when there is a change in the spot price, right? That is delta. What is gamma? The gamma is the change in the delta, relative to the change in the price. And then these are very important, right? At least you will have 1 to 2 questions. Please, remember that. Discussed about theta. What is theta? I gave you the hint also. T for T, theta is time decay. Okay. And then we mentioned about Vega. What is V? V for V, Vega change, is the change in the option premium which changes in the volatility. We discussed about what actually happened over the weekend, how the option prices will change because of those volatilities, market volatilities, right? What is rho? Rho is change in the option price with change in the risk-free interest rate. Okay. Theta, gamma, rho. Okay. Delta, sorry, theta, beta, rho, delta, and gamma. Okay. I mentioned briefly about option pricing methodology. Need not study this in detail, but just remember there are 2 models: binomial model and Black-Scholes model. If you want to experiment, but I don't require, I don't think they will ask all this, formulas and all, right? So implied volatility we discussed in detail, right? Um, and payoff diagrams. I think this is the most important part. What is going to happen for a buyer? What is going to happen for a seller, right? Who gets unlimited profit? Who gets unlimited loss? Who has to pay the premium? Who actually settles with premium? Okay, you remember that matrix, right? We discussed in detail. Again, it's the same thing. And what else? The way why I'm actually scrolling through the chapter is, and I just wanted to feel confident that we covered currency options. I wanted to show you it's the same stuff, right? Nothing else. It's the same thing that you will see in the, interest rate derivatives as well. This we studied at the start, don't worry, I will repeat this again. The main thing, just to revise the concept, what is the tick in the exchange traded derivatives? It's 0.0025. Okay. Cross currency, need not worry. Okay, let's quickly do these questions, so that you are also comfortable there. The price at which might be start attempting that, the price at which the option buyer pays to the option seller to acquire the right.
Kiran, just I want to give you one shortcut for this attending this one call, put, buy long and all, a very, very simple way. See, buy is plus, sell is minus, simple. And call is plus and put is minus. Suppose if you can remember like that, no? Suppose short call means, short means minus, call means plus. So the price action is going to be down. That's it, simple. That way, everybody can understand the bullish or bearish like that. Immediately, short call means, short put means minus into minus means plus means the price action is going to be increasing so that you can get the benefit out of it like that. Actually, that way it is very easy way it can be remembered. Just I want to put it up you for the sake of the understanding purpose, not for anything more. Kindly, if it is easy, Please remember, otherwise it is, yeah, you follow your way. That's nothing else.
No. We will actually do in detail call, like, buying a call and shorting a call, like buying a put and shorting a putting when we study the strategies and equity derivatives, which I will start tomorrow. But I think, yeah, that's a good point. Plus minus, yeah, that's like we have done that math, right? Positive times positive, positive times negative, negative times positive, negative times negative. Those are the four combinations that I have.
Yes, it will be very easy for the price action how to get remember very easy so that the people will not be confused at any point of time. That's only my point actually.
Cool. Thanks. Okay, let's attempt these questions, guys, and we'll quickly go through interest rate derivatives, and then, like, we won't take much time in interest rate. Yeah. Price at which the option buyer pays the option seller to acquire the right. What is it called? You have to
Premium.
answer there anyways. Yeah, premium, right? Okay. Option buyer faces dash risk, and then option seller faces
Limited or unlimited?
Yeah. Option is dash. If we discuss this again in detail. What is that one which gives you the positive cash flow? ATM, OTM, and ITM. Which one is that?
OTM.
In the money.
In the money.
Profit means in the money.
ATM is always zero. OTM, will
Is
give you
always
the
negative.
negative thing. Your option always gives you the money when it is in the money. Okay. Why? Simple concept.
Yeah,
Because of
1300 and
positive cash
1307.
flow.
1300
one
and
at a time.
1307. Reliance.
One at a
Reliance.
time. Yeah, one at a time. Yes. Yeah, right. So primarily always remember, the strike price, and this is the spot price. Spot is always less than the, sort of the strike there. Okay, simply. Difference between option and intrinsic value. We discussed, right? Intrinsic value is equal to, right, option premium plus time value. It's just the reverse.
You say time value.
Time value.
It's time value, right? Okay.
Can you explain this?
Which one?
Premium and intrinsic value.
I discussed this in detail yesterday, sir.
Premium is equal to intrinsic value plus time value. Suppose it is going to be this side, it is automatically
Guys,
time value.
I discussed this in detail yesterday. Please refer to the recording. Thanks.
Okay.
Yeah. The last one, right, like this premium is strike of 75.5 and the premium is 0.3. What is the break-even point?
Strike price premium.
75.8.
Strike price plus premium.
Yeah, right. Okay, perfect. Any questions on this? Actually, this is what the currency derivatives, the currency option chapter is all about. We covered everything, right, guys? Anything left here? Are you happy? Okay, fine, good, bad. Cool. Can we
Yes,
move
sir.
on? Okay. Let's quickly do the interest rate as well. It's the
No,
same thing.
actually deflected region.
Sir,
deflected
please.
Kiranji, Kiran, Kiranji, can you?
Sir, hold on. Thanks. Let me just complete this and I'll take the questions. Okay. So let's quickly go through this. The same thing, the same chapter, basics of options. We just saw what is that? European American moneyness of an option value, intrinsic, ITM, ATM, OTM. It's the same thing, right? Interest rate derivatives. See, this is the same thing that we have discussed again. Option Greeks, delta, gamma, theta, vega. Again, the types of the models, binomial, Black-Scholes, implied volatility, payoff diagrams, again, long, short, who will get what? Unlimited, limited. Yeah, it's the same thing, right? Again and again and again. And I think if you see, right, it's the same questions again, right? Option buyer pays to the required rate premium, limited, unlimited risk, So he asked about, who gets a positive cash flow item, here who gets a negative cash flow. So,
out of the money.
Out of the money. Yeah. So again, the same question, right? Difference between, option premium, intrinsic values, time value. Yeah, it's the same thing. Okay, cool, perfect. Any questions on this? Basically, right, it's the same, chapter that gets repeated. We studied in detail about equity. Now, let me take any questions, So people are talking something, So please ask any questions if you have on the equity derivatives to start with, and then we will, go to appreciation, depreciation. Someone was asking a question before, sorry.
Yeah, Kiran, there is a for implied volatility, there is a deflated or inflated. So can you have any idea deflated? Yesterday I have not attended the class, just I am asking that once.
What is that?
If implied value is the higher side, whether the price action is going to be deflated or the inflated.
Sir, I keep saying multiple times, don't, we are not here to write the PhD exam. We just try to clear the
No,
exam.
no, sir. It is just for the shake up. I know the answer. Just what I am asking is this is helpful to the
Sir,
others
that
also. That's why.
concept won't come, sir. Please, I'm putting in a lot of work actually to distill, and give you the concepts which are only required.
Okay, okay. Please carry.
Sir, if you want me to do right, I can talk for hours and hours and waste, everyone's time. Okay. The goal here is just to clear the exam and whatever is necessary, the concepts only I'm picking it up. Kindly please respect, the effort and we are putting in. Okay. Okay, someone was asking about, the okay. Someone was asking about the payoff, right? So guys, we discussed this in detail, but I'll quickly go through this, what is the payoff, right? So again, we went back. Quickly open my. See, what is sort of the payoff, right? The buyer and seller payoffs we discussed in detail. The buyer here it will become, the call guy here, and the seller will become the put guy here. It's as simple as that. So we discussed this multiple times, right? But I'll quickly repeat it, right? What is the strike price, of the house? The strike price of the house is 1 crore. Now buyer is paying a premium of 50,000, right? Now there are two scenarios here. What is the two scenarios? One, my spot is becoming, 1.2 CR. When my spot is becoming 1.2 CR, right? What is, I will execute the contract at 1 CR, right? Then what will be my payoff? Payoff is nothing but, what is the, return that I'm generally making, right? What is my payoff? 1.2 CR minus 1 CR, which is 20 lakhs minus 50,000, right? Because 50,000 is the premium that I paid, right? 19.5. So ideally, what is my payoff as a buyer? It's unlimited, right? We discussed again yesterday, right? Tomorrow the government can come and say, okay, what I'm starting an industrial hub. Instead of the spot becoming 1.2 CR, it can become 3 crores, right? So as a buyer, when I'm having a payoff, I can have an unlimited, profit that, I can make. Now, what is the second scenario that we discussed? Spot is 95 lakhs, when the spot is 95 lakhs, what ideally in this scenario, what will happen? I decide not to execute my contract, right? Because as a option buyer, I only have the right, but I am not obliged to, honor the contract. Okay. Ideally, I won't, honor the contract and I will just let the contract expire. But in case if I am honoring the contract, right? In this case, what is going to happen here? I am actually losing, sorry, my bad. Sorry, my bad. In case I'm not honoring the contract, right, as an option buyer, in that case, what is my maximum loss? What is my maximum loss? My maximum loss is
Premium
my
loss.
premium paid.
Premium.
That's it, right? Which is my 50,000.
Yeah.
Okay, guys, this is my payoff on my buyer side. Okay. Now let's come to the, seller side, right? What if we talk about, seller also can get into the market and then say, I am going to sell this house. Okay. Now, what did we say? Buyer has the right but no obligation, but seller doesn't have the, seller has to oblige, seller cannot say I am not obliging the contract. Okay. So let's go back to the same example, right? As the seller, I'm putting in 1 crore, house into the market. Okay. When I'm putting in 1 crore house into the market, there are two scenarios that can happen here, right? What is the first scenario? Sorry, what is the first scenario? The first scenario is, imagine, right? I'm actually, let's say, the house value. Guys, please put yourself on mute. Thanks. The price becomes 1.5 CR, right? What is going to happen? As a buyer, I will come and execute the contract. Okay. Now, in that case, what is happening with the seller? Seller is actually making 1.5 minus 1, which is 50 lakhs loss, right? This 1.5 can actually even become 3 crores or 4 crores, going back to our government example thing, right? So, in this case, what is happening? The loss of seller is unlimited, right? Guys, I keep requesting you to put yourself on mute. Yeah, you see my screen, right? Yeah. So the loss of the seller is what? Unlimited loss, right? It could be just need not be 1.5. It could be like 3 CR as well. Right? Now, in case the in case the house falls down to say 95 lakhs, right? What is going to happen? What is going to happen here? The buyer will say, right, I am not honoring the contract and I'm actually letting the contract expire. Okay. So in that case, what is the profit of the seller? The profit of the seller is just only the premium received. That's it, right? The whatever 50,000 or 1 lakh. Got it? So these are called payoff diagrams. This applies here. See, whatever I'm teaching, right? I'm not using jargons. Primary purpose is, I can keep using jargons and I can talk. Okay, like I actually did my econ from Columbia University. Okay, I worked at Wall Street. If I want to complicate this, I can complicate. But my goal is not that. My goal is for you to pass the exam in first attempt. That's why I'm translating everything into English. Okay. So buyer, translate that into call, in the stock market jargon. Seller translate that into put in the, stock market jargon. So whenever the question comes, right, what is the maximum payoff a caller can have? Now tell me, what is the maximum, thing a caller can have? He can have an unlimited profit, right? What is the maximum loss that he will have? It's only restricted to the premium paid. Simple.
Only the premium.
Same thing on the put side, right? What can happen? He can have an unlimited loss. He can have only actually, the profit, equivalent. He will have only limited profit, which is equivalent to premium. Got it? Whoever has asked that, are you clear, sir? Any questions on this? Because it is very, very important, you will have questions on this. Perfect. Awesome. Okay.
What are the jargons that can be used in this?
Nothing, sir.
Only payoff, right? That is the only thing.
Sir, you won't even nowhere in the exam you will get something called payoff. If he asked, you come and actually hold me. They won't.
Okay.
They will talk about what is the unlimited law, what is it that they are going to get, what is it these people are going to get. That's it. Don't worry, that's what I'm saying, right? Once we finish these concepts, we will go through, there are a bunch of 1,100 questions, we will go through all that, even though this is a 21-day program, I'm not going to teach all the 21 days. Okay. The concepts will get over as quickly as possible. It's like more of the repetition of this question that we will do. the concepts are the same, it becomes your understanding and the ability, the logic to peel that and then answer. That is exactly what this exam is all about. This exam is not tough at all, I'm telling you. Give a research analyst exam or investment advisor exam, those exams are really tough. Okay, this exam, once you understand the concept, it's very, very easy. Okay, cool guys. Any other questions on
Thank you.
Equity, currency, interest rate derivative options as a concept? These
No,
are
sir.
the concepts primarily. If we missed any concepts, what we will do is, when we do the questions, we will try to come there and then we will actually, cover that. But you are covered like 90, I would say 98, 99% you are covered with the concepts that we have learned. But again, I keep saying the PPT that I have given you, this PPT, which I have uploaded yesterday, each one of the line is, a question to you. Okay. So I have condensed everything and I have given it to you. Forget about these diagrams, etc. and all, right? I have condensed everything and these ones also, these explanations, because some people wanted to understand further. I wanted to focus, this is exactly what I have shown you yesterday, right? Theta, T for T, V for V, R for R. Okay. I am trying to make your life simple. That's it. Okay. Each one is a question for you. Don't ignore this. You have to
Yeah,
read
Kiran,
through
you have done
this.
a great effort. Yeah, really great effort. The things are very nicely presented in a systematic way, and it is really giving a glimpse of the things actually.
Cool. Everyone passed the exam. That's the goal. Okay. Cool, guys. Okay. Let's switch gears. Now, what I wanted to do is, I want to talk about which is the next. You're clear on the options part, right? Strategies using options.
किरण जी,
Yeah,
just I have like एक क्वेश्चन आप उस पे करवा सकते हैं, just one question on implied volatility, मतलब थोड़ा सा उसमें confusion था, nothing else.
just now I disturbed you, sir.
Implied volatility.
Can you please explain matrix having implied volatility? Sir, we will do that when we do the strategies, Hold on
Okay,
to it.
okay, that's fine then.
Yeah. Okay. Cool. I think let's switch gears. See, I want to cover the most important concept, right? See, there are few important concepts which you need to understand. Once you understand those concepts, the rest of the stuff is mostly the theory for this exam. Okay. As I mentioned, 6, 7, 8, 9, 10 chapters or the 1, 2 chapters there, right? Those are all theories. The main crux of this exam is chapters 3, 4, and 5. And we have done 3, already. And we have done 4, right? Now we are getting into chapter 5. What I'm doing is I will actually start with chapter 5 in currency, not in equity derivatives, because appreciation and depreciation is one concept where people get super confused. And that is why, this exam got this notorious thing that, this exam is tough. Okay. So first let's understand what is an appreciation and depreciation to start with, right? I know there are so many experts, if you want to, go ahead, tell me what is an appreciation, depreciation with regards to currency. Okay. This is all currency, guys. Okay. Please. Okay. To start with, just to, remember, make you revise some of the stuff, right? What did we say? Currency always goes in pairs, right? Currency always goes in pairs. Okay. To start with. Okay. Now, what is an appreciation? What is a depreciation? Appreciation and depreciation is always, relative to each other. Okay. That means you are comparing, one to another. Okay. That is like, you are comparing, USD to INR. Okay. So let's start with USD to INR because that's a very famous, popular thing for us. And we'll talk about a couple of scenarios. What we will do today is, we will understand the basics of, appreciation and depreciation. And NISM brings in two important, persona into the whole exam. Okay. One is an importer and another one is an exporter. Okay. What is going to happen with an importer, when the currency appreciates or depreciates? What is going to happen with a, exporter when the currency appreciates or depreciates. We will learn that, and we will see two famous questions, that this exam asks. Okay. I will not talk about, there is the most important, concept, which is hedging the currency risk. Okay. You do hedge the currency risk using the futures and the options that we have studied, okay, in the last couple of, sessions. That concept we will study tomorrow because it is little tricky concept. Okay. Tricky concept, matlab it's not tricky, but like it takes time for us to sort of explain and to, go through step by step. Okay. Okay. Now let's start with the, you can all see my screen, right?
No, sir, we cannot able to see the screen.
You're not able
No,
to see
we
the
can't
screen
see
for
the
so
screen.
long. Seriously, what is happening there? You're not able to see this. No one told me
Yeah,
that.
now
No,
now
we can
we
able to
can
see,
see.
sir.
Okay.
Yes, sir.
Okay. I keep on writing and like, okay. Sorry, guys. Okay. This is what it is, right? Currency pays USD INR appreciation, depreciation, right? So now anyone wants to attempt appreciation, depreciation in plain terms, right? English, if you want to.
When US dollar appreciates means INR depreciates.
No, that need not be the case at all. But like, yeah. One more attempt. Anyone else?
When we buy, means exchange a currency to another currency, and the value. No?
If the price moving up, it becomes appreciation. If price moving down, it becomes depreciation.
Okay.
Currency currency appreciation means currency becomes stronger. Currency depreciation means currency becomes weaker.
Very good. Nice. Perfect. Let me take one quick example here, right? So for example, I wanted to buy, right? So those are all things, but like, here we are, what we have done in this last couple of days is, we learned through a couple of examples here, right? So I'll pick up one example here. So I wanted to buy $100. Okay. I wanted to buy $100. Okay. What is this currency? This currency is my USD, right? US dollar currency. Okay. Now, today, what is my rupee value? I'm just taking hypothetical examples. Please don't go check, exchange rates and then, start debating. So today, say for example, exchange rate is 86 rupees, right? If the exchange rate is 86 rupees, how much, sorry, how much can I buy? How many rupees can I buy?
8,600.
So, yeah. The amount of INR that I will get is 8,600, right? 100 times, 86 rupees is my currency, right? Now, when the rupee becomes 88, what is my INR going to be?
88,000.
How many rupees I will get? I'm going to get 8,800 rupees. Okay. In this case, or like, we will, yeah, in this case, what exactly has happened with the currencies primarily? We just zoom this a bit. What
Rupee has
exactly?
depreciated.
Sorry?
There's no.
Rupee has depreciated.
Rupee
There's
has
no
depreciated.
Depreciated.
Correct. Everyone clear on this? Rupee has depreciated. Why?
We are getting more rupees to $1 US.
This is one way to look into that. The other way to look into that is,
Previously it required 8,600, right now 8,800, so that it is more is required, that's why it is depreciated.
that is correct. That's a very good explanation there, right? So for
Sorry.
example, okay, I'm repeating that. For example, like, earlier for me, let's understand this way, just listen to me, for a second. For me to buy $100 before, I have to spend 8,600 rupees, okay, to buy $100. But whereas the currency remains the same, 100 rupees itself. To buy $100 now, I have to spend more money, which is 8,800 rupees. You are getting my point, right? For the same currency, that I am, looking to buy, the other currency I'm actually spending more, to buy the particular currency, which means what? My currency has sort of depreciated. You're getting my point? let's look into the other way around, right? For example, today the price of the INR is 86 rupees. So tomorrow the price of INR has become 84. Okay. So as of today, if I have to buy $100, how much I have to spend? I have to spend 8,600 rupees. Tomorrow, for me to buy the same $100, I have to spend only 8,400 rupees. That means what? For lesser money, I'm getting the same currency there. Which means what? My currency has depreciated.
No,
Sorry, my
84 means
currency has
appreciated.
appreciated. Guys.
And Kiran, one more simple that we can able to remember this one. See, suppose the base currency is imprinted, quoted currency is decreases. Simple. That's why it is going to be. We
No,
can
no,
remember.
that's very bad. Linear relationship doesn't exist in currency pairs, so that's a very bad analogy, by the way, right? You can think of that, but like in a normal scenario, I think this is one of the mistakes that recently has happened. Why most of the investors have also lost money. Why people have lost money recently? People thought like when the Indian rupee has sort of depreciated, the dollar is appreciating. Okay, let's not get into the economics there, right? People have lost money because they actually thought linear relationship. Anyway, coming back to the point, right? So you got the appreciation depreciation concept here for a moment, guys. Everyone clear on this?
Yes, sir.
Yes, sir.
Perfect. Now let's actually look into a couple of scenarios here, right? We will talk about as I mentioned, NISM brings in two interesting persona into the whole exam. What is that? An importer and as well as an exporter, right? First, we will talk about an importer perspective. From an importer perspective, like what happens if the currency appreciates or when the currency depreciates, right? Now, what does an importer do primarily? Importer, what does he do actually? He either gives the he actually buys products or services into the country, and in return they pay. That's what it is, right? They pay for the products or services, right? Everyone, what is it like? We are importing, oil, like whatever the other stuff, we are actually importing, right? Now, in this case, so let's look into the first scenario, right? Now, USD as a currency sort of appreciates. Okay. What does, appreciation means? Okay. Now, before that, right, let's take this standard thing. As an importer, what I will do is I will actually, say that I will pay $1,000 standard, for the ease of calculation here. I have to pay $1,000 for my, as an importer, to my, what I meant to say, the seller there, my seller there on the other side, right? Now, what is the first scenario? US dollar appreciates. Okay, US dollar appreciates. What is generally going to happen? So, for example, like it is 64, and then tomorrow it is 68.
It's a profit for importer.
Will be long.
Profit for importer?
No,
it will be
imports
It will
import
be
become
loss.
He
more
has to pay
expensive.
more. He has to pay more.
Imports
So-
become
Yeah.
more expensive.
Exactly, right? So initially, what am I paying? Initially, I'm paying only 64,000 times on whatever 64,000. And in the case of when the USD appreciates, I'm paying 68,000, right?
68,000.
So what happens? I am paying additional stuff. Got it, guys? Everyone clear on this? It's very easy.
Yes, sir.
Paying additional stuff. What is this? This is bad for importer. Got it? Now, the reverse happens, right? USD depreciates. Say, imagine it becomes from 64 to 62, right?
62.
What happens? I have to pay initially 64,000. Instead, I will be paying 62,000 here, right?
68,000. You get a profit of 2,000.
Profit or whatever, right? Primarily, right? It's a, you can call it as profit, etc. Right? Now,
In favor of the importer.
Now, the most important point that I wanted to, build here is what
Importer
is our,
benefits.
guys, please let me speak. Thanks. Whenever, the currency, there are two ways the currency can behave, right? Either it can appreciate or it can depreciate. Okay. If I'm an importer, right, what should I be most worried about, in this instance? I need to be worried mostly about, when the currency is getting appreciated, right? When the currency depreciates, I don't care, right? That's totally fine for me. It is actually beneficial for me, right? So, as an importer, generally, right, to why is this bad? This is really bad. It can go really bad also, right? Why? For example, like what actually happened with the Indian currency over the last few months, it has gone really bad for a lot of importers. That's why, like our balance of payments have gone up. Our forex reserves were eaten up. RBI was trying to control. RBI was not trying to control. They let it free fall. Modi comes and says, "Don't buy gold." All that stuff has happened, right? So, because we are all importing oil, gold, etc., and all into the country. Okay. Now, again, as I promised, like we will discuss the strategies here. It's not that, like if I'm an importer in the real economy, I won't just leave it just like that. Okay, I won't leave it in the air for the currency to figure out its own course of path. Okay, if I'm a serious business person or if I'm doing serious business, right? I will use something called as a hedging concept. Okay. The hedging concept here, can be done either by futures or can be done either by options. Don't worry about that. We will go through multiple examples tomorrow on that. Okay. You're getting my point, right? If you are an importer, if the currency is appreciating, you are at risk. If the currency is depreciating, you are fine. If your currency is appreciating, you have to hedge your currency through futures and options. What are the strategies we will learn tomorrow. Now, the second aspect is if I am an exporter, right? What is an exporter? In the case of an exporter, now tell me. First instance, appreciates, right? What
It is
actually?
good for the exporter.
94 to 96, right? So, whenever generally, if you see, right, I don't know how many of you are active in the stock market, but whenever the currency, for example, the Indian currency depreciates, say from 84 to 86 to 88, you observe, of course, IT is doing very bad of late, but like, most of the times the IT companies will go up that day. Okay. The reason is why? Tell me.
They will get more.
Obviously, right? Let's
Normally,
say,
software
They
companies
paid
or
more.
the services are exported, so that the appreciation will be happen for that.
yeah. Okay. So 94 to 96, primarily what is happening, okay. Sorry, it appreciates, what is going to happen here, guys?
From 94 to 92.
92 or 93.
Whatever, here you make money, and whenever it is depreciates,
Lose money.
you will actually lose money here, right?
Yes.
Okay. Cool. Everyone clear on this? Let me quickly open my, PPT. Just to
Yes.
show
Yes,
you
sir.
this.
Yes, sir. Yes,
Any
sir. Yes,
questions
sir.
on this, guys?
No, sir.
Okay. Let me quickly go through this, with you. I'll upload this, go through this one more time, in the evening, or by tomorrow, right? Primarily, this is what we mentioned, right? Importer and exporter on the both sides appreciates and depreciates, and then same is the case with the, exporter, what happens with the appreciates, when it is depreciates, right? So, what generally, like, the main thing is, with the currencies, right? The currency, what we call it as an FX risk, in the traditional, whenever we are doing business,
Mm.
whether we are paying more or whether we are actually receiving, that's the most important fact. If you tend to pay more, it is actually hitting your bottom line, right? Especially if you attend, Indigo's earning calls. Indigo, always talks about FX risk. Why? Because most of the planes that they generally get in, their fleet, they have to settle in, foreign currencies, okay, not Indian. So that's what we're not getting into the stock market thing here. But anyways, the hedge we will talk about tomorrow. Don't worry about that. This also we will talk about that tomorrow. We'll do this case studies in a bit here. Okay, let's do the case studies. Thought I have this slide. Delete my slide. Okay, don't worry. Seriously. Okay. I want you guys to attempt this problem and just understand this problem first, right? This is a very common, question that, NISM asks, and they love this sort of example. Take a moment, don't rush. Okay. I will read through this and we will solve it together. This is regarding the appreciation, depreciation. Okay, what is he saying? A person must pay his son's education fee in USD after 6 months. Okay, what is the spot USD INR? 82 rupees, which means the rupee today is 82 rupees. Okay. And the 6-month forward premium is 2%. Okay, so what are they saying actually? In 6 months, the USD INR can increase by 2%. Okay, clear? He has invested 2 lakh in Indian fixed income today at 6% per annum. Okay, 6% per annum. I'm repeating it, per annum. For 6 months, and hedges his currency risk using USD INR futures. Okay, that statement is useless statement. Don't get confused or get bothered by that statement, right? Now, how many dollars can he remit at the end of 6 months? Everyone got this? Today the currency is 82. 6 months down the line, the currency will go to 2%. What is the father doing? Since he has some money now, since he has to send it only after 6 months, he has taken 2 lakhs and is putting 2 lakhs into fixed deposit. The fixed deposit will give 6% per annum, but he is putting it only for 6 months. Now tell me how much of the money he has to send, how many dollars will he be able to send after 6 months? Everyone understood this? This is a very, very important question, and I think you will get it, in the exam. There are 3 types of questions, that comes from this chapter. One is this. We will do one more. And third type is the, hedging thing, that we will study tomorrow. Importer, exporter, hedging and all. That's a little complicated, but this is very easy. Try to attempt it and I want answers. We can. Someone got it actually. Ashish sir, very good. Okay, let's do it, let's solve it, right? Let's solve it, guys. Let's solve it. Okay. The first things first, right? How do we solve it? Anyone wants to attempt? Very slowly, please.
May I?
Yes, you got it, sir, anyways.
Yeah, first, even I can also tell that. No issues, you please carry on.
Not you or Ashish, sir, someone else. No, you guys are so active. Anyone
Sure.
else want to attempt?
82 rupees. So then you have to pay 2% of 82 rupees.
Very good, right? So the first thing is what we will do is there are 2 things that are required here, right? What is the money that will be there in my hand, in the father's hand at the end of 6 months, and what will be the exchange rate at the end of 6 months, right? Those are the 2 things that we need. Exactly, right? Everyone?
Yes.
Okay. Now, what did we say? 82 plus
2%.
2%. Here is my 2%. What is my exchange rate at the end of 6 months, guys?
83.64.
Everyone clear on this? I want everyone to be super clear on this example because with you 100% you will get this question. Okay, 100%. There's no second chance at all. Okay, so 82 plus 2%. Why? He said 2% is the premium. For the 2% is the forward premium. So what I'm doing 82 plus 2%, 83.64. Everyone clear?
Yes, sir.
Okay. Now, what will be the money that I will have? Right. Now, I kept repeating multiple times. He has put in 2 lakhs into fixed deposit. And how much is the annual, this one?
6% and divided by 2 for
Very
6
good.
months.
Why?
6 months.
This is where most of the people do the mistake. Okay.
It is 6 months.
Yeah. That's what. This is where most of the people do the mistake. What they will do is, they will just blindly actually calculate 2 lakhs times 6%. But what you have to remember here is he has put in the money only for 6 months. Okay. That means the return that I am making is only 6,000, here, right? Now, plus
2 lakhs.
2 lakhs. How much
So
is that?
you will have
Divided by, what is it? 83.84
83.64.
or something? 64?
64.
Okay.
So
Everyone got it? The father will be able to send $24,462 to his son for his foreign education 6 months down the line.
okay.
Everyone got it? Please, I want you to be super clear. If not, like we will do that again and again and again. It's very easy. The
Okay.
only tricky caveat is sometimes here what they can do, is instead of 6 months, they can actually give you 8 months. Okay. There are only 2 instances, they can sometimes, if they feel that, they are very tricky, they want to make it tricky or whatever stuff, he will say 6% per annum for 8 months. Okay. Now let's also calculate that. How much will be that? 12,000 is the annual return, How much for the 8 months, guys? Tell me. Times 3 by 4.
8,000.
Simple 8,000, right? Times 3 by 4, right? Or we will do that times 3 by 4. It's easy. Sorry. Why 8,000? Yeah, it's 9,000 now. Who said 8,000?
So
Or
for
am
8
I getting it wrong?
So
it is
yearly 12,000 divided
Sir,
by
you said 8 months, sir, not for 9 months. You said 8 months.
Oh, okay, I took 9 months. Thank you, sir. Yeah. So I actually took for 3 quarters. My bad. It's 8,000, right? So 8,000 is the return and you calculate, the return here. Okay. Everyone super clear on this? Because this is very, very important question. Okay. Education fee problem. Okay. Now there is second question that is very famous, which is this one. Okay. Which is this one. Now, let's read through this. What is he saying? An investor converts INR to USD at rupees 83 and invests $100,000 into US equities. Okay. Year later, the portfolio has grown to $150,000. Right. He sells and repatriates, but converts the USD back to INR at 81 and not at 83. Okay. So how much is, the money that he is bringing back to the country? Everyone understood this? Attempt.
So that's 1,15,000 into 81, right?
Not
Divided by 81.
divided by 81.
Yes.
Should be multiplied, right? $1 is 81.
No. Okay. So let's
No.
do this. Okay, guys, hold on. Let's do this quick math in dollars here, right? So actually, Wait. I think the question is little tricky. The question should have been excellent. Yeah, it's easy only, right? Attempt.
Yes, sir. So it's $1,15 divided by 81.
Multiply.
Multiply by 81, it's
No,
93.
No, sir. Sir, he get money, he get dollar 1,15,000.
Mhm.
1
Into
lakh,
81.
it will be multiplied by 81 and not 83. The dollar price has gone down to 81 from 83.
Yeah.
But he invested $1 lakh. Now he is getting $1,15,000.
No, $1 lakh become 83 lakh dollar
Okay,
become
guys, let me explain. Let me
93
explain.
lakh 15,000 is the correct
93
answer.
lakh, right.
Yeah,
I had answered.
exactly.
I had answered it.
Yeah. So primarily, we can do one quick thing here, right? What you can do is, if you actually want, you can. But I think you got it. Most of you have got it. So primarily, what is happening? I'm least concerned about this part. He has invested $100,000, and the value of the investment have gone up to $150,000, right? But when I'm bringing back the money, I'm bringing it 81 and not at 83. Okay. So what does it mean? The first things was even before calculating, what does it mean? Am I losing value or am I gaining value here?
Losing.
Simple, very good, right?
No, sir, we are losing or we are gaining also. We had 83,000, 83 lakh we had invested. 83 lakh we had invested. It become 90.
Guys, please. Today, I think we are all over the place, unfortunately. Sorry. I'm just going with an example. I know I'm not talking about the returns that you made. I agree with that, right? For example, let's do the quick math here, right? 100,000 I have invested at 83, right? Now I wanted to bring 100,000 back at 81. Am I losing the value or am I gaining the value?
Losing.
the value.
I'm losing the value, right? But there is a little caveat here. The little caveat here is instead of $100,000, my portfolio value has gone to $115,000, right? Additional $15,000 is the value that I'm going to get. Okay. So 115,000 divided by 81, whatever is that is the value that you are going to make. Got it? Everyone clear? I think this is a little tricky. I think the question is not that. He will ask you about it has gone up by X amount. Then I am bringing it back. Then how much am I bringing it back, etc. When we do the questions, we will do that.
So can you do the calculation? I mean, just step by step, like how you did previously.
Sir, I think it is here primarily.
Kiran, with this calculation, I'm having one point. Like, miss either he invests 83 of lakhs of rupees, or it should be 81, because by that way, if I'm converting into INR, I'm getting 15% return.
Yeah. See,
But here it is showing with the 81 is a 12.23%, and with the 83 it's a 15%. That's something.
Okay.
Either
we
I'm
will
wrong
double check
or
that. No. But don't worry about that. We will do more of these examples.
Perfectly fine.
Yeah, no. You have to divide it by 93,000, 15,000 by the 83, that it will come to the 20.23%. That is the simple calculation.
Okay, cool. Any questions, guys, on this? On today's stuff?
Not yet.
Primarily on appreciation, depreciation from the importer-exporter perspective. That's what I wanted to focus upon. Any questions on that?
Hello.
Yeah.
If someone do not have any question, first of all, only then I will go ahead with this. It is just a favor. Nothing else.
Sorry.
Kiran, I don't know if you have explained in the first class or not. Can you please just guide how to navigate through your site actually, SIF Academy? I was trying to learn the notes actually. I don't know if you have
navigate through my note. Okay, site. Okay, perfect. So for now, I think I'm not. Okay, we will do that quickly. See, first of all, I think whatever we are teaching, just keep it, just go through this process, sir.
Yeah, I'm going through that. I was just reading the notes, nothing else.
Yeah. You can go through that. Primarily, see, this is what we have done, right? We have divided into themes, and this is what we have studied, right?
Right.
So, for example, if you go here, start equity derivatives.
Good. Mobile thoda vanda idive pathi.
Okay, so if you want to go to the forwards and futures, which we have already completed here, right? So you can go through the key terminology here, primarily. So again, this is all every point is possible potential question for you. Okay, and we given you sort of the trap alerts, what you have to do, and some sort of a numericals. We have done this again, right? Contract value, future price, flat times, lot size, and all that calendar spreads. We have done this, right? We have done this question also, right? 3 months ke liye, how many calendar spreads you will have? Three calendar spreads. Must remember rules, etc. And all. You can go through this, and then you can actually. Okay, you can actually revise that, and then there are a couple of questions that you can go through. You can actually attempt those questions, and in case if you get something wrong, right? For example, I think this should be 12,000, but let me put like 12 lakh. Okay. So the correct answer is this, right? So it will give you sort of an explanation on why it is going wrong. You can revise that and all that again, right? And then there is this final scan. Okay. So the reason why I'm not saying you go through this is, so whatever we have discussed is sort of a summary and concise part of what exactly has been put here, right? Again, I kept a couple of minutes ago, right? The goal is not to overwhelm yourself with so much of stuff, because that's when you get lost. Today I was speaking with a lot of AMCs and distributors, and they are like, oh, we have given the exam once and we are not ready to take the exam again because it seems so tough and all that. The goal of this, whatever we are doing, this 21 days, is to simplify as much as we can. Okay, as much as we can. Okay, and that is the effort that we are putting in. So whatever we are doing, we are studying. That's the same thing here. You can revise this, if you know. That's what we have done here. How do you use it? Prepare, revise. You have random samples here, and then there is a final scan. Got it? Okay, sir.
Sir, we have to pay for this, sir. We have to pay.
It's all free, sir. Just create an account. That's it.
Actually, Kiranji, I was just going through the themes wise, right? And I just clicked on equity derivatives. I was trying to do actually a question drill and all.